Markets podcast, where we review and have a look ahead at what's happening in the international energy markets and what a week it's going to be. Of course, Russia, Ukraine dominating the headlines, and they will continue to do so, and clearly having some kind of impact on this market. Omar, I'll start with you. Omar Najia, Global Head of Derivatives at BV Energy. Welcome and good morning. We'll look at that survey result from yesterday's question. 68% of our viewers don't feel the conflict has been priced in yet to equities, bonds, and commodities. We've seen Brent and NYMEX, WTI hit new highs this morning in Asia, $94, $95 respectively. So where are we going, Omar, with this, and how far will this prices go?
So I think we're going to get to, well, we've reached the target. I was looking for something between 94 and 97. So we've reached that. I think, we continue to tick a little bit higher. But I think, on the question of, I think that's the trend of the market. So the market is trending. The news is, the reason why 68% of the people are saying not priced in yet is because I think the markets, as opposed to, the tabloids and CNN and, Bloomberg, etc., don't believe that anybody's going to do anything. So, and I think they're right. So I think it's all a bit of...
What's been driving these prices up then the last week? Continuous sort of pressure on. I mean, it's not fundamentals, you could say, but it's fear, sentiment. What's pushing it?
It's basically people who were. There's a lot of reasons, but one of the major ones is that people, first of all, said that a few things couldn't happen. So gasoline prices or whichever way you look at them, cracks or gasoline prices couldn't be over heating oil prices in the winter. So that's happened, and basically, so they're pushing gasoline as far as they can. They then said that, we're reaching a top on crude and all that kind of stuff. So there's a lot of people who are short and still short, even though people have been calling for $100. So I think they're kind of buying. People who are long are also buying. So basically, I think that there aren't very many reasons to sell. So the trend keeps going in the direction of maximum pain, which is to the upside, until or unless there's a reason to turn prices around. So I think basically once everybody realizes that nothing happens, be it Wednesday next week or February 21st or whenever it is, we correct a little bit and then up again. So I think the main idea is you stay long this market until you get slapped in the face and until you basically know from the price action, not from anything else, that the trend is finished. So as long as basically, yeah.
Well, okay. So Bora, let me go to you on that. And Amar's talking about trends and until people feel like, that's it, we'll see things reverse. But let's talk about fundamentals. We've got the IEA calling on OPEC Plus that it must find a way, to increase supply soon, or we're going to see $100 oil, we're going to see $110 oil. We know the challenges that OPEC Plus is facing with its particular quota, some of its members, but when will we see Saudi intervene? At what price could we see Saudi say, actually, you know what, we've got to do something now? Are they going to come in to temper prices at all?
Well, I find that IEA and US calls on Saudi to be quite interesting because, I would say not internally coherent, actually, because by discouraging private sector investment into oil production, really they're creating a market concentration on just these one or two OPEC members, really one, let's say Saudi Arabia, who we can question how much spare capacity they really have without significant new investment, say by Aramco, which Saudi Arabia would itself need to raise from private markets. So they'd have to go to these private markets who have pledged not to invest in oil production to raise the, tens and hundreds of billions to increase capacity. But I just don't think there's a switch that can be flipped to really flood the markets with cheap oil.
Okay, well, I mean, one of the suppliers is Russia of that oil at the moment, and a lot of people and analysts in the last week have said, even if we see obviously the conflict escalating, hasn't happened yet, but the tensions escalating. But even if there is some kind of ground invasion, that actually Europe in particular cannot afford, for sanctions to be put on Russia or for exports to be impacted. What do you make of that? I mean, does Russia feel secure that it can still sell its oil, and is the market reassured by that?
Well, indeed, I don't think the market or Russia or anyone should be assured by sort of the tone of the geopolitics today, right? If there's a war, all bets are off, and access to commodities and goods should be more difficult, right? Now, we can go along with Omar's logic that it may not be in the interest of Putin to take military action on the day and time scheduled in the calendar by Joe Biden. And we can ask Joe Biden, why are you doing this? What's the rationale behind that? And clearly, something's at play, and there's a negotiation on the kind of future geostrategic alignment of this country, Ukraine, that is that will need to be resolved somehow, and hopefully not by force.
I mean, do you agree with the thesis that Russia is not afraid of sanctions, i.e., it's set up its financial systems already, it's protected itself with its dollar reserves, etc., and what currency it's using for trade? Has it preempted sanctions, and is there any, or will that actually check any action in the final analysis?
It's so complicated to say. In my opinion, they shouldn't be afraid of sanctions if we believe the words coming out of Vladimir Putin's mouth that he's not interested in invading Ukraine. So why would he be afraid of sanctions, right? But he's going to squeeze the variables in a way that, apart from invading a country, clearly he's squeezing his opponents, right? And what the West is saying is don't send tanks across the border, and maybe he won't do that, so he's not afraid of sanctions. But I can't believe that it would be status quo and everyone would buy Russian oil and gas, and it would be as attractive for Russia um, if he had sent tanks across the border. It won't be a nice world for Russia if there is a shooting war in Ukraine. I guarantee that it won't be a nice world for Russia. But again, Vladimir Putin saying that that's not what I'm thinking, and you guys are a bit hysterical and over egging things, but I have my aims and I'm going to try to achieve them. So there's this psyops, as they say in the
I mean,
Pentagon, going
even
on.
the president of Ukraine is telling everyone else to calm down, and he's the one who's about to be supposedly
Exactly.
attacked. Yeah,
Vladimir Zelensky said, whoa, wait a second. I need to see this evidence of the imminent
yeah.
invasion. And what we see is clearly troop buildup. And what we hear in the press through these confidential sources is perhaps there's some CIA access to other electronic communications or otherwise from inside the inner circle of the Kremlin. Can we take this on a face value? I would say let's discount all of this noise. Clearly, something's going on there, but I would say the people running the Kremlin up until now have proven to be very rational people. At the end of the day, Ukraine is a member of the United Nations, and it is an independent country recognized by Russia. They want to affect the politics of that country, but I don't see that they're going to be, annexing it or installing some kind of puppet regime. And if they did, it would be a game changer, right? And maybe that's just the message that Biden wants to give. And I think Putin's not going to play into that trap. I
Yeah.
think yes, clearly a negative for the Russian people not to have this cozy relationship with Germany and the EU.
Yeah, yeah.
It clearly wouldn't be as cozy.
And thanks, Bora. Professor James McAdam, Executive Chairman of Exergy and Professor of Energy at Strathclyde University. Welcome. Good morning again, James.
Morning, Gaila.
Just to address one or two of those points with you, let's talk a bit about fundamentals, and let's talk about fundamental supply in the market. I mean, we've got a shortage today in the immediate term, but many agree that from March, from second quarter, we're going to have plenty of supply coming back, whether that's a bit more from OPEC, plus putting the Ukrainian-Russia situation aside. Let's talk a bit about shale. There's been certainly a bit of an impetus there in the last couple of months where it hadn't been moving much last year. Is it back? We had, I think, 19 rigs added last week, which was considered a 4-year record for a weekly volume of rigs. I believe, are we confident that shale is back, and how far is it going to go with these prices?
At these prices, Diala, clearly shale is economic, but we need to look beyond the headlines of rig count surging at an increase of whether it's 19 or 22 based on different reports yesterday. These numbers are still relatively small when you go back to 2014. The rig count is as a third of what it was in 2014 when the basins were producing at their max. So the reality is that yes, it's there, and companies are taking advantage of the opportunity, and it's for the most part tending to still be the bigger players that are doing that. But there's a couple of other interesting articles in the digest today which give us some real indicators of what's actually happening on the global stage. So clearly, most of the super majors reporting record cash flow positions in the course of the last quarter in terms of the result. Now, cash flow there coming from two areas. Yes, revenue generated from increased oil prices, but perhaps significantly, the second one is not spending money on capex or what is actually being described as capital discipline. I've repeatedly made the point that the wells in the Permian that are being brought online are recompleted wells or wells which have already been drilled, and that continues to be the case. In fact, if you actually take a look at what's been happening to the companies responsible for fracking or completions, their activity numbers are up a third, if you like, from where the lows were. So clearly, what we're seeing is it's completion activity, not necessarily new drilling activity. And whether that's going to continue to be couched as capital discipline or not, the companies are simply not investing in new activity.
We also have an article on the bulletin which is saying how some European banks are still funding, oil and gas, E&P, and is that, that's obviously there's an appetite for that for oil and gas companies. How much of are companies under sort of shareholder pressure resisting sort of the transition because of profit, bottom line? At the same time, yes, they're being held up to go along with the green transition. So where do companies stand now? How can they sort of manage that balance with all this money coming in available for capex?
So there's been a couple of really interesting. Hello, have you got me?
Yeah, we can hear you. Yeah, you froze for a second.
There's been a couple of very interesting comments from the likes of Bernard Looney of BP in the course of the last week, where clearly he's making his position that he doesn't want to see the United Kingdom introduce a windfall tax on the super majors in light of these record profits. And both himself and Shell have been quick to point out that these profits will be diverted into low carbon technologies and energy diversification solutions. However, the interesting thing, I think your point is there that you made about the banks, there is a growing rhetoric around the European banks in particular, putting money into gas activity. And even the EU Commission, I think in one of your articles yesterday, has begun to reignite the gas as a transition fuel debate, saying, yes, oil, yeah, we're not in favor of financing in that space. And we would, we would condemn, if you like, the banking sector supporting new oil activity. But certainly gas activity, that's acceptable. And when you take a look at the banks that you're talking about, HSBC, Barclays, BNP Paribas, it is interesting that those investments that you're talking about have gone into gas-related activity. And back to a point that was just made, the companies that they are supporting are Exxon in the States, BP, Shell, and significantly Saudi Aramco. So back to the point that was just made a second ago as to where is the money going to come from for increased activity, we're starting to see the financial sector looking at, if you like, this energy constraint environment that we live in, whether that's gas into Europe, or indeed it's what's actually going to happen in terms of short-term oil supply-demand imbalance. The banks are moving back into what Sean would call, if you like, the responsible capital bucket around, particularly energy transition fuel, which is gas.
Yeah, my point around that would be, these capital flows from the banks are definitely being concentrated into fewer buckets. Okay, if you're you can list them on one hand, right? Whereas before you would have had dozens and dozens of players developing these opportunities in the North Sea, offshore Norway, in the Mediterranean, and a lot of investment going into Africa, reserve-based lending, gas production, LNG projects driven by entrepreneurs. Now it's the shots are being called by national oil companies and super majors, and that's what the banks feel comfortable aligning themselves with, which I'm not sure is going to solve the kind of price constraint issues that the world is grappling with.
In the short term, Omar, let's just talk about the price again. You've said a few times recently that as of March, as of the second quarter, that's it. We're not going to see oil prices with much more support. That's where you'd see the turning point. Again, putting a war aside, what about the whole support that's coming from the commodities commodities train in general, i.e., those are still rocketing, really, commodity prices. We've still got supply chain issues, which compounds that. Will that not carry oil along with it?
No, I think they're all gonna turn at the same time. So I think wheat prices, I think cocoa prices, I think coffee prices, and a lot of other prices of commodities. Basically, forget about metals, but those kinds of commodities, soybean oil, all those, basically cotton, etc. I think they're gonna run out of steam to the upside. End of March, early April. You can never be too kind of certain, but I do think that commodities in general, we are at the tail end of this rally, and tail ends are usually characterized by these kinds of questions. So euphoria, everything's going up, it's all going to keep going, blah, blah, blah. And people forget that we started at plus or minus, if you ignore that, minus $10 for oil. So I think basically we've come a long way. Whatever people say about, fundamentals and, we haven't had investment, we're not going to have investment. The green thing is a political decision, has nothing to do with anything else. It's basically the West deciding that, we've polluted the planet for the last, 300, whatever years. And now, we can't do it anymore. So we're going to force up energy prices and we're going to all go green because all of a sudden we love the planet. And if you're in the kind of emerging economies where you need a lot of energies, then you're going to be punished because you're bad. So, I mean, it's farcical, but people just slap it up and here we go. And we have to be green. And are you green? And am I green? And do you compost and all this kind of stuff? It's farcical. So Europe is already paying through the nose for energy. Anything that happens with Russia means they're going to pay through every single orifice imaginable. LNG prices from the US are just not competitive. You've had Biden laughably go and talk to Qatar. So all in all, Sorry, I don't know what happened.
Interesting image. That's fine. Yeah, Star Wars, we always like that. Bora, thanks, Amar. Bora, just on that point, I mean, Amar's saying, from the second quarter, everything is going to just have run out of steam, but we still see demand, global demand for everything. Very healthy. We're still in kind of recovery mode from COVID, whether it's for energy or commodities and the supply chain bottlenecks, as I mentioned, have kept that all supported, and we haven't seen really much easing on that supply chain global bottleneck yet. So what's your opinion on that? I mean, isn't the demand story, and look at what's happening in America, obviously trying to temper that whole inflation story. Would you agree with Amar there? We've got the Fed, about to do 2 rate hikes in March.
Well, the Fed and the ECB are still massively injecting liquidity into the system, and they will continue to do that for some time because it's only a gradual tapering which is being envisioned. And I keep emphasizing this point. This sort of conventional wisdom, North Atlantic consensus policy of injecting liquidity into the system, quantitative easing, only 10 years ago, that would have been considered, extraordinary measures appropriate for financial crisis mitigation, yep. Right?
Putting aside the money flow, let's look at the interest rate policy. I know that the quantitative easing is slightly being pulled back, but people are dismissing that now and just saying, okay, there's still money in the system. But what about?
There's a lot of money.
There is, but so should they be pushing interest rates up quicker and higher? Sooner.
So the question is, there's a lot of money in the system, such that it's creating in the U.S. 9% annualized increase in wages, and spending is very strong. Corporate earnings are very strong, right? And interest rates are at whatever 0.25%, historic lows. So what the Fed guidance is that there will be 150 bips, 1.5% increase in the Fed rate throughout the course of this year. And there's a bit of a debate between Mary Daly and Jim Bullard. Should it be, in baby steps, or let's just leap in maybe 2 steps to that 150 basis points? Well, if you have inflation running at 7%, you still have negative interest rates. So it is quite a supportive market for asset prices, and that's the wave that Omar is suggesting traders ride until they get slapped, right? But they don't see themselves getting slapped, because even if you have 2% interest rates, the question is long-term inflation going to be more or less than 2%? And likely it's going to be more than that, given just the measures that have been announced. So additional measures will be required in the future, and the market is just discounting that in terms of it's too far away, that we'll think about it later.
James, we just had our survey question up there as well. Will we hit $100 oil this week? I don't think I've asked any of you that, actually. I'll come back to that in our closing comments and see what we get back from our audience. James, just to go back to you, let's talk a little bit about consumers who are on the receiving end of all these prices. Europe, of course, being one party, especially with the gas and heating oil, etc. That they had, under a lot of pressure there in the UK and elsewhere, and Germany, as you said, very vulnerable to what might happen with Russia. And also China, obviously, the other one of the other big consumers, in India. A few comments coming out of them, but where would you say there's more concern within Europe in the immediate price scenario, or in the larger consuming nations?
I think, look, if you're sitting in India, clearly oil prices are of a great concern. And if your question is to put a line in the sand there, oil prices go up above $100 a barrel, and that's really, really painful for the emerging economies, particularly India. We listened to one of your speakers yesterday, make a very solid point that through to 2040, China will be a very large importer of gas, going forward, and certainly Europe probably the third marketplace there in terms of gas. So the reality is that these energy prices are hurting the world's major economies. Perhaps the only country that sits on the fence on that is the United States as a net exporter. So they lose on one hand but gain on the other, and perhaps some of that is what's actually driving the current geopolitical rhetoric in terms of for the United States, the impact of where this goes, particularly in a sanctions space. It is not painful to the United States, but it would be enormously painful to Europe, and it would be enormously painful into China. So I tend to share the view that whilst this might be a short-term position, and if we're to believe the OPEC position on that we will get back to a supply-demand balance that makes for a healthier price regime. The reality is that as both my colleagues are commenting, everybody is reacting in the now right now. There's a sort of a short-term panic that's going on. Interestingly, I thought Christoph's point yesterday around, will this affect the bigger markets? The Ukraine-Russia point, no. And I did, off the back of Christoph's comment, have a quick look at where the Singapore market was this morning, and pretty flat, really, despite all of the rhetoric and the news. So I think, people are sitting on the fence, watching what's happening right now. I think for me, as I said earlier on, the really interesting subtext in your articles today is this position of the EU taking that gas is a transition fuel and coming off the fence with regards to that, and sort of like saying that that's okay, and therefore it's okay to invest into that. The banks coming in behind that, or perhaps ahead of that, in terms of financing some of the big players, which is exactly the right point that was made. It's not the small players, it's not the entrepreneurs, it's not the small oil and gas companies, it's definitely not offshore. The offshore drillers, no increase in rig count.
Well, we had Xavier Chen on yesterday with Christophe from China. He's based in Thailand, but he's talking on behalf of China, saying they don't even see gas as a transition fuel. It's here to stay, so it's going to be a part of this fuel mix forever and ever. Omar, let's just look at that in terms of, I don't like those results when we're almost 50-50. That's kind of a boring result, but there you go. Omar, your view, will we hit $100 this week? Is there anything else this week that we're expecting from a numbers stats point that can push things one way or another?
I think we get to somewhere between where we are now to 97 basis WTI. So yeah, you could get to very close to 100, but I think the most interesting bit is going to be the pullback that then follows. So I think we're close to a point where we get this pullback, and that will be declared as the death of oil and death of whatever. And I think that is when we will buy more and look for another push higher into unsustainable, unbelievable, impossible. And then, you stay with it, you get slapped in the face and everything collapses. And people say, well, obvious, it was always obvious that, we went too high and everybody got too greedy and all this kind of stuff. So I want to see that. I want to see, like they say that everything ends, or it only ends when the fat lady sings. I want to see the fat lady. I want to see her come up and sing, and then I'll know that it's finished. So there's no point kind of saying, she's in the wings, she's gurgling, she's gargling, and here she comes. I want to hear her sing.
Bora, is that fat lady $100 oil? Is that what we need to hit before we see things turn down? Would you say, just even from a sentiment point of view, or are we going to continue to see CPI numbers come out and updates that will just keep all of that supported? We had, the market was supposedly surprised last Friday when inflation in the US blipped above 7%. Yes. What point would you agree with Omar? Would we see a bit of a sort of complacency and a downturn in this?
I want to see how that debate between Mary Daly and Jim Bullard pans out. Those two Fed governors, and at the minimum, if there's a 50 basis points increase in the Fed rate in March, that keeps us on track for this sort of this level of inflation. Something greater than that would definitely put the brakes on the economy, which I don't see that happening. If we had 100 basis points rise by July, that would be impressive. That's the Bullard wing. But the Mary Daly wing is saying just take it at 25 basis points and take it slow, and then let's watch and wait, because they don't want to pop the market's bubble. That's what they're concerned about, is how any type of retrenchment in asset values would impact corporate sentiment to keep employing people. I
Yeah,
think
or
that's
even
how they justify themselves.
yeah,
But
or,
in my view, the, the 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 greater pain to the working class, which the equity and progressive side of the politics should be worried about, is this inflationary impact on the working class. As we said, this is hurting India. This is hurting emerging economies. Okay, they don't care about that, but even just the regular American truck driver or the Canadian truck driver is not happy under these inflationary conditions. And I think we need a break on that. That is always driven by not OPEC, it's driven by the central banks of the developed countries, and let's see how they move in March.
yeah, and they will continue to manage it as they have been on the upside, I suppose, on the downside as well, and perhaps not go too far as well if they see economic growth being impacted, which is, another sort of argument against moving too fast. So thanks very much, gentlemen. We've run out of time. Bora Berryman, Professor James McCallum, and Amar Najia, thank you very much for joining us today. Happy Valentine's again to you all, and our viewers. Go out and buy those flowers quickly if you haven't already. And we look forward to seeing you again next week. Bye, everybody.
Thank you, Diala. Thanks all.
Thank you, Diala. Take care.
Thank you, Diala. Thank you. Thank you. Bye-bye.